income tax brackets spanned from 10% all the way up to 39.6%, with major leaps in marginal tax rates for married taxpayers of the tax cuts. Given that many of you have questions about recent tax reform, I wanted to take a brief moment to discuss some of the basic provisions of the Tax Cuts and Jobs Act. I am going to focus on provisions that have more sweeping applicability for individuals and for businesses. If you have questions, feel free to reach out to us at Cooper Norman for further explanation and guidance regarding this tax bill. The tax bill is formally known as the Tax Cuts and Jobs Act. The bill has been approved by Congress and has made its way to the White House for final approval and signature. The tax bill impacts virtually every individual and business on a level not seen in the last 30 years. In general, the tax bill calls for lowering the individual and corporate tax rates, repealing many credits and deductions, enhancing the child tax credit, modifying business tax deductions, and much more. The bill also impacts the Affordable Care Act. Please note that virtually every element of this tax reform has an effective date starting in 2018 and beyond. To begin, I'd like to discuss tax reform as it relates to individuals. First, there have been modifications made to the individual income tax brackets. Under prior law, individual income tax brackets spanned from 10% all the way up to 39.6%, with major leaps in marginal tax rates for married taxpayers with taxable income greater than $77,000. For example, a taxpayer in the top tax bracket in 2017 would pay 39.6% marginal tax starting at a taxable income of $480,000. The new bill carries with it tax rates spanning from 10% to 37%. The largest leap in marginal tax rate remains at $77,000 for married taxpayers. However, you will note that the taxable income over which each rate applies has been widened. For example, a taxpayer in the top tax bracket in 2017 would pay 39.6% in marginal taxes starting at a taxable income of $480,000. Under the newly enacted bill, a taxpayer enters the top tax bracket of 37% with a taxable income of $600,000. These rate changes in the bill expire after 2025. While ordinary income tax brackets have changed, the tax treatment for qualified dividends and for capital gains have remained unchanged from 2017. Also, please note that the bill does not repeal the net investment tax or the additional Medicare surtax, which has historically impacted taxpayers with large amounts of passive income or very large wages. While the net investment tax has remained intact, the penalty under the individual mandate to have health insurance has been removed. While taxpayers can expect a lower effective tax rate, please be mindful of the substantial modifications that have been made to the standard deduction and to the personal exemptions. The new tax bill calls for a near doubling of the standard deduction. Previously, married filing joint individuals had a standard deduction of $13,000 and single individuals had a standard deduction of $6,500. Under the new bill, married filing joint individuals have a standard deduction of $24,000 and single individuals have a standard deduction of $12,000. One goal of a higher standard deduction is to simplify the tax filing through cutting those taxpayers who would otherwise do better by itemizing their deductions. However, for a vast majority of married filing joint taxpayers, those with allowable mortgage interest, state income taxes, local income taxes, real estate taxes, and sizable charitable contributions will find it more difficult feeling the benefit from having made those payments. With fewer individuals claiming those deductions, this could have a broad impact on real estate prices, and it can also impact charitable organizations. This presents a need for taxpayers to evaluate the amount and timing of certain charitable contributions that they make every single year to maximize their use of the standard deduction as well as the charitable contributions that they are making. The bill eliminates the deduction for personal exemptions through 2025. However, an enhanced child tax credit is positioned to make up for some of the difference for certain families. I will discuss this enhanced child tax credit in just a moment. So we've discussed the modifications made to the standard deduction. The tax bill further makes substantial modifications to individual itemized deductions as well. First, the phase out for itemized deductions for high income taxpayers, this has historically been known as the PEAS limitation, has been entirely repealed. Consequently, high income taxpayers can expect to receive more of a direct benefit for itemized deductions in future years. However, while the repeal of the phase out is beneficial, the bill simultaneously eliminates many of the itemized deductions that taxpayers have historically enjoyed. First, mortgage interest deductions are now being limited to interest on mortgages of $750,000. Historically, that limit has been $1 million of acquisition debt. Second, the tax benefit of paying state and local income taxes has been substantially limited to now being deductible only to the extent of $10,000. This $10,000 cap is inclusive of real estate taxes paid as well. The bill enhances the medical expenses deduction as well. The bill lowers the threshold for the deduction to 7.5% of AGI for the tax years 2017 and 2018. There has also been a repeal of other miscellaneous itemized deductions, such as unreimbursed employee expenses. While this was discussed heavily, the alternative minimum tax does remain for individuals with some modifications. Now, as a reminder, the AMT is a parallel tax system designed to maximize the amount of tax that an individual has to pay. The AMT is imposed at a nearly flat rate on an adjusted amount of taxable income above a certain threshold. This threshold is known as an exemption. Historically, the exemption has been at about $84,000 for married filing joint taxpayers. The bill increases this exemption for married filing joint taxpayers to about $110,000. It also raises the exemption phase-out level so that the AMT exemption would apply to an income level of $1 million for joint filers. The bill increases the current child tax credit from $1,000 to $2,000 per qualifying child. Additionally, up to $1,400 per qualifying child would be refundable. The bill also raises the adjusted gross income phase-out thresholds. Historically, that phase-out threshold has been at $110,000. The bill raises that threshold to $400,000, making the credit available to more taxpayers. This enhancement to the child tax credit has been highlighted as one of the provisions that will lower the overall tax liability of middle-class America and will serve as a remedy to the elimination of the personal exemption previously discussed. The bill retains the student loan interest deduction and keeps most of the education-related credits, such as the American Opportunity Tax Credit, intact for future benefit. However, the bill does not renew the above-the-line deduction for educator expenses that expired at the end of 2016. For taxpayers who pay and receive alimony, the taxable impact of such payments has been repealed. Previously, the maximum federal estate tax rate was 40% with a $5.5 million individual exclusion, which married couples were capable of combining for a total of $11 million. While the maximum federal estate tax rate remains at 40%, the bill does introduce new exclusion amounts that will allow a married couple to exempt up to $22 million for 2018 from any estate or gift tax. Heirs will continue to receive a stepped-up basis for inherited property for purposes of subsequent sale. The bill is set to sunset after December 31, 2025, and revert back to a $5 million exclusion absent some additional congressional intervention. This recent change has many taxpayers considering the usefulness of large gifts from their estate. Taxpayers with marital estates in excess of the old $11 million exclusion would likely benefit from exploring gifting options within the next few years. I'd now like to briefly cover some of the impactive business tax laws. Currently, the top corporate tax rate is 35%. The bill revises this top corporate tax rate to 21% beginning in 2018 and makes permanent this revision. Taxpayers considering which entity type is best for them should look beyond just the tax rates. Each entity structure, whether it be a sole proprietorship, an LLC, an S Corp, or a C Corp, presents different opportunities and barriers. Furthermore, deciding which entity type you'd like to employ based on tax reform can be problematic, as laws are subject to change with political climates. I recommend that all decisions surrounding entity type should involve your CPA, as well as an in-depth discussion about past, present, and possible taxation structures that may impact you. An exciting change to the bill was the revisions to the bonus depreciation in Section 179 depreciation. The bill increases the prior 50% bonus depreciation allowance on new equipment to a 100% depreciation deduction for property placed in service after September 27th, 2017. Furthermore, it expands bonus depreciation's applicability to used property as well. The bonus depreciation rate has fluctuated radically over the last 15 years. It has been seen as a means to incentivize business growth and job expansion. The 100% bonus depreciation is set to be in effect till December 31, 2022, after which it is scheduled to undergo some form of phase out. Section 179 has historically allowed business owners to expense up to $500,000 of qualifying property in the year of acquisition without regard to whether the property was new or used. The bill enhances this expensing limit to $1 million, subject to some limitations. Now, the differences between bonus depreciation and Section 179 narrowed substantially with this new bill. However, there still does exist some small differences between the two. The IRS categorizes assets into classes, namely 5-year assets, 7-year assets, 10-year assets, etc. Section 179 expensing can be applied to a single asset acquired in the year without impacting other assets acquired in that same year of the same class life. Bonus depreciation is known as a class election, meaning that if you elect to bonus depreciate one asset of a specific class life, it is required that you expense all qualifying assets within that same class. A combination of both bonus depreciation and Section 179 will likely be a part of most business owners' ongoing tax strategy. Previously, most business use vehicles were subject to depreciation limitations. Most business use vehicles were limited to a $3,160 first-year depreciation limitation. The bill raises this cap on depreciation for business use vehicles to $10,000 in the first year, and each subsequent year receiving an enhancement. For example, in the second year, $16,000, and the third year, $9,600, and $5,700 in each subsequent year until the value of the vehicle is entirely depreciated. Many business deductions and credits were modified by this bill. First, the Domestic Production Activity Deduction, or DPAD as it's commonly known, was eliminated. DPAD generally has been helpful to businesses involved in manufacturing or production of their own goods domestically. Next, non-real property like-kind exchanges have also been eliminated. In simple terms, the trade-in of a business vehicle or piece of equipment can no longer be done on a gain-deferred basis. Taxpayers will recognize gain on trade-ins and exchanges of equipment. I suspect that the 100% bonus depreciation and the enhanced Section 179 will likely alleviate the additional gain taxpayers will recognize. Third, the research and development credit has been modified, requiring taxpayers to amortize the expenditures they earmark as research and development over 5 years. Next, the bill creates a credit for employers paying their employees for family or for medical leave. The bill also caps the deduction that business owners can take on interest expense to 30% of adjusted taxable income. Perhaps the most discussed element of business tax reform is the pass-through deduction. Historically, owners of partnerships, S corporations, and sole proprietorships, known as pass-through entities, pay tax on business income at their individual tax rates. The newly enacted bill allows for a 20% reduction in pass-through taxable income before being taxed at the owner's individual income tax rates. This 20% reduction is subject to a few limitations. First, businesses must be a qualifying trade or business. The bill excludes businesses that primarily perform services, such as health, law, consulting, financial services, and other businesses that rely on the reputation or skill of the owners. However, there is an exception. If the taxpayer has less than $315,000 of taxable income before the 20% deduction, the aforementioned limitation does not apply. Unfortunately, it is still a little unclear how trade or business is going to be determined or defined. The second limitation to the 20% reduction is related to the business's W-2 wages. The 20% deduction is generally limited to 50% of the W-2 wages of the business. This W-2 wage limitation would not apply, again, if the taxpayer's taxable income was less than $315,000 before the 20% reduction. Given that this can be a little difficult to understand, I wanted to walk you through an example. Suppose that we have a business that is a qualified trader business for purposes of this pass-through deduction. Let's suppose that this business, for simplicity's sake, has one owner, and that qualified business income for the year was $1 million. Let's also presume that this business has $220,000 of W-2 wages. In this instance, the pass-through deduction is limited to the lesser of two numbers, 20% of qualified business income or 1/2 of W-2 wages. In the example provided, the business owner would receive a pass-through deduction of $110,000 or 1/2 of W-2 wages paid in the current year. Merry Christmas and a Happy New Year from all of us at Cooper Norman. If you have any questions or concerns, please feel free to call us.
Hello and welcome to Money in Life TV. My name is Mike. Welcome to 2018, everybody. And since it's the start of 2018, what better topic to start off with than tax reform? In today's video, I'm going to be covering in plain English many of the 2018 tax law updates that will affect your personal tax return. If you're new to our channel, I just want to take a moment and say welcome. If you're somebody who's interested in learning more about finances, more about how taxes work, more about investing, then I would highly consider subscribing to our channel, as we produce new videos every single week surrounding those subjects. And we also produce videos that are going to help you in your career and your life. If you find this video helpful, please don't forget to hit that like button before you leave. All right, let's get started. Just a reminder that for 2017, for this tax season that's coming up in April, remember, you're still going to follow the 2017 rules, okay? Many people are getting it confused, which is easy to do. These new tax law changes are really going to impact the return you file in 2019, okay? So just keep that in mind. We're still, for 2018 on April 15th, we're still going to follow the 2017 tax law. All right, ladies and gentlemen, I thought the easiest way for me to show you this information and talk about the Tax Cuts and Jobs Act's 2018 tax reform bill was actually to just show you on screen so that you have a visual of everything we're going to be talking about. So what I did is I made a spreadsheet, or I put together a spreadsheet based off many sources. And just so you know, here's some links to the sources I used to create this spreadsheet. If you want more detail, or if you feel there's something, hey, Mike, you didn't cover that. Well, check out those links. There's a ton of information in there, including a link to the actual legitimate tax bill itself. Now, if you've never seen a tax bill, what it looks like, you can actually find them on the congress.gov website. So, but I already have it up. So just so you know what a real tax bill looks like. Oh my goodness, it's a real tax bill. This is what it looks like. So once they've, battled it out in Congress and it's went through the House, the Senate, the Ways and Means Committee, and all those different places, then they get this bill finalized. And as you can see, if you have trouble sleeping at night, then please feel free to read this. It's 185 pages of legal jargon about taxes.
Ain't nobody got time for that.
What more could you ask for, really, ladies and gentlemen? I couldn't ask for more myself. I have not had trouble sleeping since. But this is where the official bill is, and this is where you can read it. But anyways, so let's go to this spreadsheet I put together for you. And I have a nice little present for you, is the spreadsheet itself. So what I'm going to do is I'm going to put a Dropbox link to this spreadsheet so you can download it for yourself and you don't have to recreate the reel or anything. And what I did to create this is I read probably 20 to 30 pages of information, and I pulled what I felt to be the most important aspects of this tax bill for your individual taxes. Now, remember, we're just talking about individual taxes, and put them together into tables and visual forms in the spreadsheet. So all you have to have to read it in Microsoft Excel. If you don't have Microsoft Excel, I'll see if I can get it to you in another format, but just
all right, now, secured entrepreneurs.
Like I said, I always do recommend you do your own research on this kind of stuff if you want to learn more. So let's go ahead and get started. So let's start off by talking about
In this
rates, because
video,
that's
I'm
one
going
of the
to
biggest
answer your
changes
questions
that
about
has just occurred is
Biden's
the tax rates
proposed
themselves.
tax plan
So
and how
revised
it
tax
affects the
brackets.
secured
And
entrepreneur.
I'm only showing
I'm reading
two
your
statuses
emails.
here. If
No
you
need
file
to
single
panic. You
and
know,
if you
Mr.
file
Aurora has your
marriage.
back, and I want to thank
Why?
you for emailing me. Please continue to do so at info@auroradayconsulting.com. I'm going to go to the board and I'm going to show you what's going on with this proposed tax plan. So let's get into it. You already know I am Miss Aurora Day, and this is the Secured Entrepreneur Movement. All right, so here's the Secured Entrepreneur quadrant, all right? We got the sole proprietor. You may be using a DBA. You may have an LLC, so you think you have protection, but you're actually a single member LLC. Ridiculous. This is a sole proprietor that actually has a cash flowing money engine, okay? So you're cash flowing right here, but you're self-employed. And you may also still be a DBA here. And you may also still be a single member LLC here, okay? Here's the CEO. Here's, travel from SP to CEO up here. So you may have a business that is properly structured, okay? Now I know that a few of you who are doing corps, because you're telling me you are actually incorporated, but you have less than 500 employees. As a matter of fact, you have less than 50 employees. So we would have to really see about why it is you incorporated in the first place, because that's double taxation. But I'm not going to get into that in this video, because in this video, we're really talking about the changes to the tax plan and how that affects the entrepreneur who is operating in commerce incorrectly, okay? And then here is the secured entrepreneur. So you're in the investor space. You got some JV collaborations, okay? So let me go here. So as the sole proprietor in the DBA, you're doing a DBA, and you may have a single member LLC, but you're earning less than $400,000. This is less than $400,000. No matter how this shakes out, you're still going at the 60% tax. You're still up here. Why? Because under the new proposed plan, okay, and I don't want to get too deep into it because it's not, we don't have it yet, but this is what's being proposed, okay? So if you're here as a sole proprietor, you're making some money, went out there and got a DBA, you registered it with your county, you got a bank account with, you may have gone to the IRS and got an EIN for a sole proprietor. You may have went up on LegalZoom or whatever these paper mills places, and you got an LLC in a state, but it's not properly structured, and you are still filing a 1040. So you're paying All right, now, secured entrepreneurs, in this video, I'm going to answer your questions about Biden's proposed tax plan and how it affects the secured entrepreneur. I'm reading your emails. No need to panic. You know Ms. Aurora has your back, and I want to thank you for emailing me. Please continue to do so at info@auroradayconsulting.com. I'm going to go to the board and I'm going to show you what's going on with this proposed tax plan. So let's get into it. You already know I am Ms. Aurora Day, and this is the Secured Entrepreneur Movement. County, you got a bank account with, you may have gone to the IRS and got an EIN for a sole proprietor. You may have went up on LegalZoom or whatever these paper mills places and you got an LLC in a state, but it's not properly structured and you are still filing a 1040. So you're paying self-employment tax, okay? And the itemized deductions that you would have had are no longer available to you. There's going to be a lot of cuts with itemized deductions, okay? So this is bad all the way around. Then, of course, now you've got the sole proprietor, and this is really who has the red dot on the forehead. This is the red dot on the forehead space right here, because you're cash flowing. If you are making more than 400K, this is where all the taxes are going to start. Okay, so now there is a 28% situation going on here, and let Ms. Aurora explain that to you. Before I get into the 28%, let Ms. Aurora back it up and explain something to you. No matter what, in this space, you are already at the 40% tax. Okay, how did you get there? First of all, the current rate of tax here for the individual taxpayer in this position is 37%, okay? And then you tacked on the 16% self-employment tax and whatever deductions that you were not able to get, you don't have children, things of that nature, you ended up at 40% or more, depending on how much money you claimed. Especially if it was over $200,000 and you didn't really have any deductions, you were facing the 40% in this space, okay? Now, so because it's currently 37%, the current proposed tax change is going to take it from 37% for the individual taxpayer who is earning 400K or above to 39.5% tax. Okay, so now you're going to tack the 16% self-employment tax on there, and the deductions that you may have had previously, you will no longer have, because at the 400K and above, now there's a cap of 28% cap on the deduction. This is what Biden is proposing, okay? So the dangerous part here for the sole proprietor, who is not a secured entrepreneur yet, is that you are cash flowing. You do have a money engine, but you're still operating like a sole proprietor who maybe just has a DBA, or like I said, you have an LLC, but it's a single member LLC. It's not structured properly. You're still filing a 1040. You have an individual tax return, okay? And so you're still in here at the 60%, okay? And I don't know what it's going to shake out as, okay? Because this is just the preliminaries that we're able to get right now. It's not etched in stone just yet, okay? But under 400K, you're not doing too bad as far as the tax that you pay when you're operating in commerce incorrectly. It's when you get down here and you're making more than 400K a year and you're filing as an individual taxpayer, regardless of what business you think you have, because you're not in business here, okay? You really don't get into business till you get here, okay? And we got a news flash here. So I was saying that for those of you who were saying that you you've incorporated your company, but you don't really have more than 500 employees, well, you really is still a small business. So you would have to justify the reasoning for incorporating, because now the corporate tax rate under Biden's proposed plan is now going to go back up. Let me see. Going to go back up. Right now, we're at 21. We're 21, 20 to 21% tax. It's going back up 28% for corps. Okay, it's going back up 28%. All right, but when you are in this position, all right, when you're operating in commerce properly, you're at the 20% tax rate. Now, like I said, the corporate tax is going from 20 to 21 right now to 28%. Okay. When you're operating in commerce properly, you're going to be between 20% and 0. And I'm going to tell you why. The reason why you can be at a 20% to 0 in this space right here, when you're operating in commerce properly and you have a real business, is because you will now have the opportunity to utilize all of the legal tax deferral strategies possible. Okay, it is all of our jobs to have the correct legal entities. Okay, so even if you're here, and I'm really singling out single member businesses, you actually are a single member business, but you're operating all wrong. You don't have the correct legal structure. You're not collecting monies properly. You're still filing a 1040. And see, because you want to pay yourself, okay, I tell people all the time, if you don't read Rich Dad Poor Dad, I don't know what to tell you, because you have to come away from putting yourself on a payroll. See, right here in this area, you're getting hit hard if you have created a payroll and you're on it. Okay, you're on it. Even if you're here as a corp and there's a payroll and you're on it, you're still an employee. Okay, you're in the 60% right here as an employee. Okay, you're an employee. You're paying all the taxes that an employee would pay. Okay, it's not a joke. Right here. Okay. When you're here and you're operating properly, you are giving yourself every opportunity to create a pass-through tax scenario. Okay, so now I'm passing the tax through to another entity. Okay, I have no interest in collecting a paycheck. I'm wealthy. All right, I've got entities that take care of me, and I'm not going to get into it in this video, but Biden also has something as it relates to the estate gift tax and all these things. That's another video, and I can stay up all night getting into that, but I won't. Okay, so we want to be here to 0. We want to be here to 0. Okay, now we're going to come down here to the secured entrepreneur. 0 tax. Okay, because let me tell you, Biden has something for people who are earning more than $1 million a year as well. So when you get down here, what's happening? You have all of your entities in place. You have deployed, utilized, strategized. Remember, this is about tax planning, controlling, and managing. Okay, so that means that I'm using every tax deferral strategy, all right, so that I can create and build tax-free wealth. Okay, this is the name of the game right here. So you all know that if you are not operating in commerce properly, you need to click the links below and get on Mr. Rora's calendar. It's more imperative now more than ever, because it looks like Biden is going to take office. Okay, and if you're the sole proprietor, which many are, because everybody's cash flowing right now. We have all come up in this pandemic. I don't know anyone personally in business who has not flourished during the pandemic. I kid you not, okay? So you're 400K and above for the year, all right? You got a cap on your deductions. It's a 28% cap, okay, buddy? All right? You're going from 37% taxation to 39.5% taxation. You're still hitting the 40 and above tax, okay? You're still living the 1040 lifestyle. You're still a sole proprietor. It's not gonna work. Give it up. You need to be here. You need to go from sole proprietor to CEO, okay? And then straight on down to secured entrepreneurship, where you're going to be able to mingle with like-minded business people who are operating the same way in commerce, legally avoiding taxation by deploying all tax deferral strategies, okay? That's what I want to say in answer to what you all are asking about how Biden's going to affect, how Biden's tax plan may affect the entrepreneur. Well, it might not when you're operating in commerce properly. All right, now Mr. Rohrer gave you a little bit of it. There's a whole lot more, and we can get into it as time goes on. But for those of you who know that you're operating in commerce incorrectly, go down below, get on Mr. Rohrer's calendar. Let's get it in, okay? And you already know that you can find me, Mr. Aurora Day, at auroradayconsulting.com. And until next time, ta-ta.
What's going on YouTube? My name is Chris, and in today's video, I'm going to explore the world of options trading with you, even if you don't know one thing about options trading. I will be explaining the most important options trading concepts to you using examples, lots of examples, and visualizations so that you can understand and actually see how options work in the real world. My goal is to provide you with all the information that I would put into a beginner course, but give you everything for free. So with that being said, grab your favorite beer, your favorite wine, kombucha, or whatever your thing is, and let's get started. So the first step in our options trading journey today is to first understand and learn about the basic option characteristics that all options have, and briefly discuss how options are different from shares of stock. Option characteristic number one is that all options have an expiration date. This is different from shares of stock because if you buy a share of a company's stock, there's no expiration date on that position. You can hold that share of stock forever as long as that company doesn't go private. There's nothing that's forcing you from closing that position. But with options, all option contracts have an expiration date, and the expiration date could be today or it could be 2.5 years from now. And that means that when you are trading options, you have to choose a time frame for your position. Now, this will make more sense when we go through the examples in just a second. But the first thing to know is that all options have an expiration date. And after that expiration date, that option will no longer exist. Option characteristic number two is that all options have what is called a strike price. The strike price is the price in which the option can be converted into shares of stock. And exactly what that means is that if I have an option with a strike price of $105, that means that in the future, if I want to buy or sell shares of stock using my option, I can do so at the option strike price of $105. So this is really important, and it doesn't have to make sense right now, but basically an option's entire valuation or price is based on the fact that it has the ability to be converted into shares of stock at its strike price. So we'll go through a bunch of examples, so don't worry if this doesn't make sense quite yet. Option characteristic number three that we have to discuss, and the final one that we will discuss before moving forward, is what is called the option contract multiplier. So this is really confusing, and I hate it myself as someone who teaches options because it makes things pretty confusing. But if I see a share of stock that has a stock price of $120, I can buy one share of that stock with $120. But if I see an option and the option price is $5, I cannot actually buy that option with $5 US. I actually need $500 because options on stocks can be converted into 100 shares of stock. And because of that, we have to multiply the price that we see by 100 to get the option's actual value, or what is called the option premium. So let's build on these 3 option characteristics, and let's move forward by discussing the 2 option types and get into some examples and clearly look at what these 3 characteristics mean in regards to the examples. The first option type is called a call option. At a very high level, call option prices will increase as the stock price increases, and call option prices will decrease as the stock price decreases. So the price of call options moves with the stock price. But why do call option prices move with the stock price? Well, a call option gives the buyer the right to buy 100 shares of stock at the call option strike price between now and the expiration date of that option. Remember that one of the characteristics of all options is that they have a strike price. And for call options, the call option can be used to purchase 100 shares of stock at the call option's strike price. And as we'll see in an example in just a moment, the ability to purchase shares at the call option strike price, which never changes, will get immensely valuable if the stock price increases significantly higher than that call option strike price, because the option can then be used to purchase shares of stock at a steep discount to the current share price. So without getting into an actual option or stock market example just yet, let's explore what a call option does and how it works by using a very simple example. Let's imagine that there is a house and the current value of this house is $200,000. Now, I am personally interested in buying this house because I think that the value of the house is going to appreciate significantly over the next 2 years. But I don't want to buy the house right this second. So I'm going to buy an option that gives me the right to buy the house at a price of $200,000 between now and 2 years from now. So we can call the strike price $200,000, since my option that I'm buying on this house gives me the right to buy the house for $200,000, or at the strike price of $200,000 between now and the expiration date in 2 years from now. So that's what I'm going to do. I'm going to buy this option that gives me the right to buy this house for $200,000, no matter what the house price does between now and 2 years from now. But I don't just get the ability to purchase this house for $200,000 between now and 2 years from now for free. I have to pay for this contract because for me, there has to be some sort of risk. There can't just be reward. If somebody were to say, you can buy this house for $200,000 between now and 2 years from now, no matter what, and you don't have to pay for that right at all. Well, that would be amazing for me, because if the house price falls, I don't have to buy the house. But if the house price goes up to $300,000, then I can buy the house at $200,000, and there was never any risk for me, but there was only reward. So that's not a real scenario, and for me, there has to be some risk. And what that means is that I have to pay a premium for the right to buy this house at $200,000 between now and 2 years from now. So we would call that the option premium. Let's say that I pay $10,000 for this option. So I'm saying I want to buy this house for $200,000, which is the strike price, between now and 2 years from now, which is the expiration date. And my premium for having that ability over that time frame is $10,000. Now, let's say that 1 year from now, the house is valued at $350,000. I have possession of a financial contract that gives me the right to purchase that house for $200,000. And with the house currently valued at $350,000, what do you think that means for the value of the financial contract that I have, which is called an option? Well, as you might imagine, since I can buy the house for $200,000, but the house is currently valued at $350,000, the financial contract that I have, which is called an option, is immensely valuable. So now I can actually exercise my option, meaning that I will buy the house at the strike price, which is $200,000. And since the house is currently valued at $350,000, I am buying something that is worth $350,000 for a value of $200,000. And because of that, we could say that my profit from this scenario is $150,000. So that's the golden scenario. Now, because I paid $10,000 for the option initially, my net profit in this case would not be the full $150,000. It would be $140,000. So my total profit minus what I paid for the option initially. So that is the golden scenario. But let's say the opposite happened and the house price did not increase and actually fell to $150,000 2 years from my purchase date of that option. Well, I don't actually have to buy the house for $200,000 because I had an option to buy it, but I don't have to exercise my right to buy the house at the strike price. So since the house is at $150,000, obviously I don't want to buy it at my strike price of $200,000 because if I really wanted that house, I could just buy it at the current market price of $150,000. And because of that, the option that I have is worthless. And since I paid $10,000 for that option and now it is not worth anything, I have lost my full $10,000 that I invested into that option. But if we compare this to the loss I would have had if I purchased the house initially without buying an option, I would have paid $200,000 for the house. And at the current price of $150,000, I have lost $50,000 as opposed to the $10,000 that I lost in my option premium example. So with the option, I only lost $10,000, but if I would have just bought the house initially, I would have lost $50,000. So with options, you have limited risk and immense upside potential, which is why traders love to buy options. So let's take all of these concepts that we just discussed with this basic house example